Welcome to the deep dive. Our mission, as always, is to take a whole stack of sources, articles, research, complex documents, and, really pull out the essential knowledge for you.
So you can be the most well-informed person in the room without having to do all that heavy lifting yourself.
And today, we are focusing on a term that is, it's fundamental to pretty much every financial conversation on the planet. Net worth.
You hear it everywhere, right? Headlines about billionaires, advice columns, everywhere. It's basically the core financial scorecard.
Exactly. But here's the thing. Net worth is kind of a chameleon. The simple equation assets minus liabilities, it acts completely differently depending on who you're talking about.
You mean for a person versus a huge company?
A person, a company, or even an entire country. The math isn't the hard part. It's the valuation, the accounting rules behind the numbers. That's where it gets complicated.
And those nuances are everything. If you understand why a government's net worth is just fundamentally different from a company's, you get this powerful lens to view, financial health, stability.
Risk on a global scale. And that's what our deep dive today is all about. We want to go way beyond the dictionary definition and find those aha moments.
The things that separate just knowing the term from really, truly understanding it.
So let's start at the beginning. The universal baseline. No matter the scale, individual, corporate, country, what is the big, broad definition of net worth we need to start with?
It's actually, it's elegantly simple, but it's also profoundly important. At its very core, net worth is what's left over. It's the residual value after all your obligations are paid.
So everything you own minus everything you owe.
That's it in a nutshell.
Okay, let's unpack this.
So we have to start with a sort of formal definition, the financial baseline. Net worth is the value of all non-financial and financial assets owned by an entity.
An entity being a person, a company.
Right, an individual or an institution. And you take that total value and you subtract the value of all its outstanding liabilities.
Now, that phrasing is very specific. You said non-financial and financial assets. Why split them up like that? Why not just say total assets?
Well, you could, but isolating them is really crucial for getting a structural understanding of wealth, especially when you look at the alternate way of expressing it that our sources bring up.
Okay, an alternate expression. So instead of just assets minus liabilities, what's the other formula?
You can define net worth as the sum of your non-financial assets plus your net financial assets.
Net financial assets. What does that mean?
That's just your financial assets minus your outstanding liabilities. The reason this view is so helpful is because it forces you to separate things. It separates what you can easily trade or liquidate, your stocks and cash.
Your financial wealth.
Right, from your physical wealth, like your house, which takes a lot more time to turn into cash.
Okay, let's do a quick thought experiment for everyone listening, just to make this really concrete. Let's imagine a person, we'll call them the learner.
Okay.
The learner has three things. A home worth, say, $300,000. That's a non-financial asset.
Mm-hmm.
A brokerage account with $100,000 in stocks. That's a financial asset.
Yeah.
And $50,000 in credit card debt. That's a liability.
Okay, so with the standard equation, it's pretty simple. Assets are $400,000, the $300K home plus the $100K in stocks.
Right.
Liabilities are $50,000, so 400 minus 50. Their net worth is $350,000. Simple subtraction.
But now let's use that alternate expression. Non-financial assets plus net financial assets. How does that look?
Okay, so first you have to figure out the net financial assets. That's the $100,000 in financial assets, the stocks, minus the $50,000 in liabilities.
Which leaves $50,000.
Exactly, $50,000 in net financial assets. Then you add the non-financial asset, the home, which is $300,000. $300,000 plus $50,000.
Gets you to the same $350,000 net worth?
The result is identical, but the insight you get is totally different.
And what is that insight? What does that second method really show you?
It clarifies that the person's financial position, the liquid, on-paper part of their wealth, is only $50,000.
I see. So if they needed cash tomorrow for an emergency, their actual cushion is pretty thin, even though their total net worth seems really substantial.
Precisely. It's all tied up in the house. It really emphasizes the importance of liquidity. It shows that a high net worth that's all in, say, physical property can hide a vulnerable cash position.
Yeah.
It's a really powerful way to look at your own finances.
Let's dig a bit more into those building blocks then. Assets versus liabilities. Let's start with the good side, the assets. What typically falls under that umbrella?
Well, the list is pretty long, and it covers two main value categories. On the non-financial side, you have tangible physical stuff. Homes, of course,
Yeah.
investment properties, land, vehicles.
Even things like valuable art.
Absolutely. Art, valuable equipment, things that hold value but, take time and effort to sell.
And then the financial assets,
Hmm.
the more liquid stuff.
Yeah, this is where you capture wealth that's stored in financial instruments. The super liquid stuff is cash in your bank accounts, checking, savings, money market accounts.
Right.
Then you move into investments. A little less liquid, but still easy to trade. Stocks, bonds, mutual funds, even an ownership stake in a private business. All of that adds to the asset side of the equation.
So basically, anything you own that gives you a current or future economic benefit is an asset. Now, for the other side of the ledger, liabilities, the debts, the things our sources say actively deplete your resources.
Liabilities are any financial obligation that's going to require you to pay out resources in the future. For most people and companies, the two biggest categories are loans and mortgages.
For a person, that could be a student loan, a car loan. For a company, maybe a line of credit or long-term bonds.
Exactly. And for a business, there's another really crucial one, accounts payable, or AP.
And that's very different from a long-term loan, isn't it?
Oh, completely. Accounts payable is all about short-term operational debt. It's the money a business owes its suppliers for things it bought on credit. It's the immediate day-to-day debt you have to pay to keep the lights on.
So whether it's a 30-year mortgage or a 30-day invoice from a vendor, they both get subtracted from the asset pool.
The moment you take on that obligation, you're creating a liability, and it immediately hits your net worth calculation.
And that universality is what makes it so powerful. The structure is the same for companies, individuals, governments.
The whole economy. The scale changes, the details change, but that core equation assets minus liabilities, it's the universal language for financial health. It's the baseline truth.
But that simple baseline gets incredibly complicated when you go from, say, your personal spreadsheet to the books of a massive publicly traded company. The whole vocabulary changes.
It really does.
When we get into the corporate world, the term net worth kind of vanishes from the official documents, right? It's replaced by something else.
That's right. For companies, you almost always hear it called equity, specifically shareholder equity. You also might hear it called book value. It's the shareholder's residual claim on the company's assets after all the debts are paid.
And this is where we hit the first huge difference. The valuation of those assets and liabilities isn't based on what they're worth today on the open market.
No, it's based on their historical cost, adjusted over time. You've hit on this critical concept of carrying value.
The carrying value.
Corporate net worth is fundamentally based on the carrying value of its assets and liabilities. It's the number you see on the balance sheet, the one that follows GAAP or IFRS accounting rules.
Okay, let's really break this down, because this is where the number can start to be, well, misleading if you don't know what you're looking at. If a company bought a factory machine for $1 million 10 years ago, and it has a 20-year useful life, how does carrying value work?
It works through depreciation. Accounting rules say you have to spread the cost of that machine over its useful life. So, using a simple straight line method, they might deduct $50,000 every year, $1 million divided by 20 years.
Right.
After 10 years, they've accumulated $500,000 in depreciation.
So the carrying value, the number on the balance sheet for that machine, is now only $500,000.
Exactly. Now, imagine two scenarios. First, the industry has changed, that machine is obsolete, and you couldn't sell it for more than $50,000. The book value is wildly inflated.
Okay.
Or, second scenario, the technology is revolutionary, it's performing better than ever, and a competitor would pay you $1.5 million for it today. Now the book value is wildly understated.
So this is the key limitation. The net worth figure for a company is just an internal accounting snapshot. It's not designed to reflect what's happening in the real world right now.
That is the essential caveat you have to grasp. To the extent that the balance sheet numbers don't reflect true market value, the corporate net worth figure will be just as inaccurate. It's book value, not market price.
And if those inaccuracies start piling up on the liability side, a company can end up in a really bad spot with a negative net worth.
Negative net worth in a business is a massive red flag, a huge distress signal. It means the company's accumulated losses are bigger than all money shareholders ever put in, plus any profits it retained.
In simple terms, it owes more than its assets are worth, at least on paper.
Right. It signals insolvency. It can trigger debt covenants or, in the worst cases, lead straight to bankruptcy.
But this brings us to a fascinating contradiction. If corporate net worth is based on these rigid historical numbers and can be so inaccurate, why do we even use it? Why do lenders, especially, rely on it so much?
Here's where it gets really interesting.
Because that disconnect is just fundamental. A company's net worth, its book value, does not express the market value of the firm. You could have a tech company with almost no physical assets, so a tiny book value.
But $1 billion market cap.
Exactly, because the market is valuing things the balance sheet completely ignores.
It's valuing the business as a going concern. It's looking at all the expected future profits, the brand recognition, the customer base, the secret sauce. The market looks forward. The balance sheet looks backward.
So, if the market cap, what people will actually pay for the company, is 10 times the book value, why do banks still care so much about those balance sheet numbers? Isn't book value basically useless for a loan decision?
That's a great question, but book value is still vital for a few big reasons. First, collateral. Lenders aren't lending against future profits. They're lending against the tangible assets they can seize and sell if the business goes under.
So the carrying value gives them a floor. It's an imperfect floor, but it's a standardized, legally recognized floor for what those assets are worth in a liquidation.
Precisely. It's their baseline for recovery. And second, debt covenants. Banks write loan agreements that force businesses to maintain certain financial ratios based on their book value.
Like a minimum debt-to-equity ratio.
Exactly. If the company's book net worth drops too low and they breach that covenant, the bank can call the loan immediately. It's a regulatory tripwire.
And speaking of ratios, the relationship between net worth and debt is obviously crucial when you're trying to get new financing in the first place.
Oh, absolutely. Lenders scrutinize that equity cushion. A high net worth tells them the owners have a lot of their own skin in the game. It means the shareholders will absorb losses before the bank's money is at risk. It's all about risk mitigation.
This also gets into the idea that business owners need to trade on equity to grow their net worth. What does that phrase, trading on equity, actually mean?
It's really about self-funding growth. It means the business is using its own capital specifically, its retained earnings, which are profits it reinvested instead of paying out to finance its expansion.
So instead of going to the bank for a loan to buy a new machine, they use the cash and profits they made last year.
Exactly. When you rely less on debt and more on your own success, your balance sheet gets stronger, your assets grow, but your liabilities don't, so your net worth goes up. It shows confidence, stability, and it means you're less reliant on outside financing.
So corporate net worth, or equity, is this critical internal and regulatory benchmark. It's essential for lenders who need a collateral floor, even if it totally fails to capture the true market excitement or future potential of the business. It measures the past.
Now let's bring it back home to the individual level. For most people listening, this is where the concept becomes really immediate and actionable. For individuals, net worth is just another word for wealth. It defines your net economic position.
This is the number that really dictates your financial life, your retirement timeline, your ability to handle an emergency, your legacy. Let's get into the personal assets and liabilities because some of them are different from what a corporation has.
On the asset side, yes, we still have homes and cars, but the financial assets are often in these very specific tax-advantaged accounts. We're talking about retirement accounts, 401ks, IRAs, Roth IRAs.
For many people, that's their single biggest financial asset.
It often is, yeah, thanks to decades of compounding growth. We also count other brokerage accounts and things like cash value life insurance.
And on the liability side, there's a really important distinction for personal finance: secured versus unsecured debt.
Crucially important. Secured debt is any debt where you've pledged an asset as collateral. If you don't pay, the lender can legally take that specific asset.
The classic example is a home mortgage.
A home mortgage, an auto loan, sometimes a margin loan against your investments. These are generally seen as less risky for the lender because they have that collateral to fall back on.
And unsecured debt is the opposite. There's no collateral backing it up. This is most consumer debt, right?
Right. Credit card balances, medical bills, personal loans. If you default on those, the lender's only real option is to send you to collections or sue you. They can't just come and repossess your television.
Which is why the interest rates are so much higher.
Exactly. The risk to the lender is much, much greater. So for an individual trying to boost their net worth, paying down that high-interest unsecured debt is almost always the fastest way to do it. You're just eliminating that liability.
Okay, but now we have to talk about the Well, the philosophical paradox of personal net worth. The things we all know are incredibly valuable, but that don't show up on the balance sheet. I'm talking about intangible assets, like a college degree.
Our sources make a specific point about this, and it is a curious exclusion. Intangible assets, your education, professional licenses, unique skills, even a great job contract, are typically not factored into the numerical calculation of net worth.
But that feels fundamentally wrong. Someone invests $150,000 in a medical degree. They create a huge liability, the student loan, which crushes their net worth. But the asset, the degree that will earn them millions over their lifetime, is valued at zero.
It is a profound limitation of the metric, and it all comes down to the core accounting principles of measurability and transferability. Net worth is designed to measure assets that have an objective, quantifiable value.
And that you can sell.
That's the key. Assets that can be sold or transferred to pay off your debts.
You can't sell your law degree to pay off your mortgage.
You can't. You can sell a house, you can sell a stock. You can't transfer the economic benefit of your education to someone else to satisfy a debt. So in the cold, hard math of the balance sheet, your education is treated as a sunk cost. It will boost your future income for sure, but it's not an existing asset you can count today.
So it forces you to accept that net worth isn't a measure of your potential or your human capital. It's a measure of your existing transferable economic position. It's a snapshot of today, not a forecast of tomorrow.
But even with that limitation, knowing your net worth is incredibly practical. First and foremost, it's the single best reference point for measuring your financial progress over time.
It's your benchmark. If your net worth is $50,000 this year and $40,000 next year, you have to figure out why. Did your investments tank? Or did you just take on too much new debt?
And beyond tracking, it's a powerful tool for changing your behavior. When you actually calculate your net worth regularly, it just naturally makes you think twice about spending. It motivates you to pay off debt.
I can see that. Seeing that $5,000 credit card balance directly subtract from your wealth makes the consequence so much more real.
It really does. It encourages saving, it encourages investing.
And the single biggest life event where this number becomes absolutely critical is, of course, retirement.
Absolutely. Retirement is the ultimate test of your net worth. It has to be large enough to generate the passive income you need to live on for 20 or 30 years after you stop working. It goes from being a snapshot of today to a projection of your future survival.
And just to touch on it briefly, the financial industry has its own lingo for people based on their net worth, right? HNWI, UHNWI.
Right. High net worth individuals and ultra high net worth individuals. These are just classifications that private banks and wealth managers use. Generally, an HNWI has over $1 million in liquid investable assets. UHNWIs are usually $30 million and up.
So it's more of a marketing category for financial services.
Pretty much, yeah. And finally, in the legal world, after someone passes away, their net worth calculation becomes critical for probate.
The courts needed to figure out the value of the estate.
Exactly. They have to assess the total assets so they can be distributed to the heirs, but only after all the outstanding liabilities, all the person's debts, are settled first. It's the final legally binding calculation of a financial life.
So from paying off debt to planning for retirement, net worth is intensely personal. But now we have to do our last and biggest scaling up exercise. We're going from the personal balance sheet to entities with trillion-dollar budgets. We're going to the macro level, governments and countries.
And this is where the concept has to stretch, and where it gets really complex and, frankly, very debated. Governments are the largest financial operations in the world, and they can and do create balance sheets with all their assets and liabilities.
When we talk about a government's net worth, what's the point? We're always hearing about government debt. Is calculating net worth just a way to provide some context for that debt?
That's a huge part of it. It serves as an alternative measure of a government's financial strength. Hearing a government owes $25 trillion is a scary number, but it's meaningless on its own. You have to know what the government owns.
Because a massive government will have massive debt, but it should also have massive assets.
And if the value of those assets significantly offsets the debt, then the picture of financial health looks a lot less scary than just looking at the debt number alone. It reframes borrowing as an investment.
It gives you a true picture of long-term fiscal health. But what even counts as a government asset? What are the big-ticket items on a country's balance sheet?
Let's make this tangible, because these assets often just feel like they're owned by the public without a real dollar value.
Mm.
The biggest categories are non-financial assets, especially infrastructure and land.
So like the entire interstate highway system.
The highway system, bridges, tunnels, all with a monumental replacement value. Airports, seaports, military bases, every federal building, power grids, the value of all that physical infrastructure is just staggering.
So the U.S. government isn't just counting the White House. It's counting every mile of road, every aircraft carrier, every post office, based on its original cost minus depreciation.
Precisely.
Mhm.
And then there's land, vast federal land holdings,
Mhm.
national parks, national forests, millions of acres of BLM land, all with potential mineral or resource value. Even if they can't be sold, they have an accounting value.
What about purely financial assets?
The big one is the gold and foreign exchange reserves held by the central bank. The government also has accounts receivable taxes that are owed but haven't been paid yet, and in some countries, investments in state-owned companies or sovereign wealth funds.
And all of that gets weighed against liabilities like government bonds, unfunded pension promises, and other commitments. But calculating this introduces a huge debate over accounting methods. Accrual versus cash.
And this choice is a really big deal. It can drastically change the final number. Accrual-based accounting, which is what most companies and many governments now use, is much better for transparency. It records transactions when they happen, not when the cash moves.
Okay, give us an analogy. If the government promises a new employee a pension today, but they won't get paid for 20 years, how does accrual accounting treat that?
Accrual accounting recognizes the full present value of that future pension promise as a liability today. The moment the promise is made, it shows the true cost of government operations right now, which is great for transparency.
So it's like a family putting the kids' future college tuition on their personal balance sheet the day they're born. It's transparent, even if the bill isn't due for 18 years. That seems like the responsible way to do it.
It's responsible, but it can be politically painful. When a government switches to accrual, all these massive, previously hidden obligations suddenly appear on the books, and the net worth figure can plummet.
And the alternative to that is cash accounting.
Cash accounting is simpler. A transaction only gets recorded when money actually changes hands. It's better for seeing your immediate cash flow. With that pension, cash accounting wouldn't recognize any liability until 20 years from now when the first check is cut.
So cash accounting might hide those long-term costs, but it gives leaders a clearer picture of the cash they have on hand right now.
Exactly. But for an organization the size of a government, you absolutely need consistent, effective accounting, no matter which system you choose, just to have any hope of identifying your true total net worth.
And finally, let's go to the very top, the largest possible aggregation. National net worth. How on earth is that calculated?
National net worth is the ultimate sum of everything. It's calculated by adding up the net worth of all private companies and all individuals living in the country, and then you add the government's own net worth to that.
It's the total collective wealth held inside a country's borders.
The source gives a figure for the U.S., and even though it's a bit dated, it gives you a sense of the incredible scale.
What was the number?
In the United States, this is called the financial position. And as of 2014, it was $123.8 trillion.
Wow. And of course, as the source notes, that number is out of date. It's constantly changing as asset values fluctuate. But still, $123.8 trillion. What does a number like that even tell us?
It's the clearest measure of a country's economic resilience. It's the total buffer against financial shocks. It's the wealth that can be mobilized for investment, for innovation, for recovery. It's a measure of a country's economic weight on the world stage.
It turns the abstract idea of a national economy into a hard, quantifiable number.
And illustrates the collective financial power held within those borders.
So what does this all mean? We started with a really simple equation: assets minus liabilities. And we've seen how net worth acts as this core measure of financial standing at every single level, from your personal budget all the way up to national fiscal policy.
The synthesis is really powerful. It's a vital tool for an individual tracking their progress toward retirement.
And it's the regulatory floor for a bank making a corporate lending decision.
And it's the necessary context for understanding government debt.
But the deeper we went, the more we saw that this metric has these crucial limitations. And those are really the key takeaways for anyone listening.
First and foremost, For companies, that huge gap between the accounting-based carrying value and the true market value of the business, the balance sheet is not the sale price.
Right. And for individuals, it's that strange, inconsequential exclusion of intangible assets like education. Your degree adds to your lifetime earnings, but because you can't sell it, it doesn't count, which means your net worth number understates your human capital.
And finally, for governments, that big choice between accrual accounting, which is transparent about long-term promises like pensions, and cash accounting, which is more focused on immediate liquidity, that choice fundamentally changes the reported national net worth.
So net worth is this indispensable lens, but it's not a perfect one. It measures what's measurable, but sometimes the things it leaves out are the most valuable.
Which leads us to a final provocative thought. It builds directly on that limitation you mentioned about human potential. If valuable intangible assets like education and skills are excluded from personal net worth, how might the collective value of a nation's human capital affect its true financial position?
That's interesting. So that $123.8 trillion figure for the U.S. financial position, it doesn't include the value of every doctor, every engineer, every innovator in the country.
Exactly. If we could somehow quantify the economic advantage that comes from having a highly educated and innovative population, that unseen wealth, how much higher would a country's true resilient net worth actually be?
It makes you look past the hard numbers and think about what other non-quantifiable things like technological expertise or political stability or even cultural capital really create lasting resilient wealth.
It's the ultimate metric for what we own, but it's not necessarily a full measure of what we are.
A fascinating concept to think about as you maybe review your own finances this week. Thanks for joining us for this deep dive into net worth beyond the balance sheet.